What if I told you the real reason your mortgage is still expensive, your rent hasn't dropped, and your portfolio keeps randomly bleeding has nothing to do with inflation, nothing to do with AI, and nothing to do with whatever political drama is trending this week? What if the real answer is sitting 6,800 miles away in a country famous for anime, sushi, and vending machines that sell almost everything? Because right now, Japan is quietly pulling a thread, and if that thread snaps, it could unravel the entire global financial system, and almost nobody is talking about it. Think about the last time you checked your mortgage rate and felt your stomach drop, or when the market suddenly fell for no clear reason, or when you heard about rate cuts, but your financial life still felt tight. You were told rate cuts fix everything. You were told the system is stable. You were told someone is always in control. But what if the real controller isn't the Fed? What if it's someone far away, quietly moving money back home? To understand this, we need to go back 30 years. In the early 1990s, Japan's economy collapsed. A massive real estate bubble burst. The stock market crashed, and Japan entered what's now called the lost decades. Growth slowed. Inflation disappeared. Confidence vanished. So Japan did the only thing it could. It cut interest rates, then cut them again, then pushed them to zero, and eventually below zero. They even introduced something called yield curve control, which basically means they forced long-term interest rates to stay extremely low. For decades, Japanese bonds paid almost nothing. So if you're managing billions of dollars, what do? You look somewhere else. And that's where the yen carry trade begins. Here's how it works. Borrow money in Japan at near zero interest, convert it into dollars, invest in higher yield assets, and keep the difference. Simple. But when borrowing is almost free, you don't just buy safe assets, you buy stocks, real estate, global investments, anything that gives a higher return. Over time, this grew into a massive system, trillions of dollars flowing from Japan into global markets. For decades, the world was quietly running on Japanese money, and almost nobody noticed because it was boring. Until now, in 2024, something changed. Japan raised interest rates for the first time in years, and then they raised them again. Markets reacted instantly. Stocks dropped, volatility surged, because the entire system was built on one assumption, that Japanese rates would stay near zero forever. And the moment that changed, the math broke. Borrowing got more expensive, returns shrank, risk increased. And when a trillion-dollar trade starts to unwind, money doesn't slowly leave, it rushes. Now here's where it hits you. The 10-year government bond yield. That's not just a number, it affects everything. Mortgage rates, business loans, stock valuations. And here's the key point. Central banks don't fully control it. It's driven by supply and demand. For decades, Japan was one of the biggest buyers of global debt. Consistent, reliable, massive. But now, they don't need to look overseas anymore. They can earn more at home. So demand drops. And when demand drops, yields rise. Higher yields mean more expensive mortgages, more expensive loans, more pressure on markets. Even if rates are cut, your reality might not improve. This isn't just a market story. This is a structural shift, a slow, quiet change in how the global system is funded. For decades, easy money flowed from one place. Now, that flow is reversing, and the system is adjusting. But here's the problem. The biggest risks in finance are never loud. They don't trend. They don't go viral. They move slowly until suddenly they don't. The real risks aren't the ones everyone talks about. They're the quiet ones, the technical ones, the ones hiding in plain sight. If you want to understand what's actually moving markets, not the noise, but the real drivers, then stay here, because these are the stories that matter. Hit subscribe, turn on notifications, and I'll see you in the next one.